Coming up on Market to Market, Wall Street takes a bruising and keeps on cruising. Producers navigate volatile waters in the quest for a renewable future. And U.S. farmers recycle old methods to round up super weeds. Those stories and market analysis with Dan Hueber next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, January 22 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The economy took another wild ride this week, driven once again by erratic oil values, China's shifting economy, and the end of cheap money. Extending its worst ever annual start, Wall Street endured alternating reversals of fortune to settle the week slightly higher. The Labor Department revealed the Consumer Price Index, a benchmark of all goods and services, dropped 0.1% in December. But when the volatile food and energy sectors are removed, core CPI rose 0.1% to cap a year that saw the second slowest rate of inflation in 5 decades. Housing starts stumbled 2.5%, but 2015 marked the strongest home construction since the housing bubble burst, triggering the Great Recession. The February crude oil contract closed out midweek below $27, a 13-year low. However, the March rollover rocketed past the $32 mark despite government reports of record inventories. This week, the International Energy Agency claimed lower oil prices threatened to derail December's Paris Climate Agreement. Nearly 200 countries pledged to reduce carbon emissions, largely through the adoption of renewable energies. But low-cost fossil fuel could delay that transition. The U.S. is the top exporter of ethanol, a homegrown renewable derived mostly from corn. But falling grain prices and a reduction in federal blending mandates under the renewable fuel standard have put a strain on returns.
You will kill RFS, and Iowa will have her fingerprints on the weapon.
Presidential politics overshadowed the 10th annual Iowa Renewable Fuel Summit this week, but that didn't mean the infrastructure of the industry wasn't discussed in the event held in the Hawkeye State. Leaders in the renewable fuels arena took the dais to trumpet milestones and challenges facing the industry. A drop in the price of black gold has been a body blow to the oil companies, but a boon to drivers taking advantage of the reduced sticker price to pile into the car more and hit the road.
So when the oil price came down, gas prices came down, gas use went up. People started driving more. From 130 to maybe 140, this next year 145 billion gallons. Well, that's like an extra billion gallons of ethanol being blended because we're in all those gallons.
But profitability for the corn producer is a little trickier, according to Shaw. And the renewable fuels sector is still navigating the restructured renewable fuel standard as issued by the Environmental Protection Agency.
We had 8 years where we expanded demand for corn by growing the ethanol industry. We had the price of corn above the cost of production, really for the first time in a quarter century on a sustained basis. And that was great for rural America. Now, with the EPA kind of watering down the RFS, we've turned and we're back into the red.
The Obama administration's agriculture ambassador told the crowd about the nearly 400,000 Americans employed by the renewable fuels industry. Secretary Tom Vilsack touted the predominantly corn-based fuels part in reducing the trade gap, cutting dependence on foreign oil, and improving the economy in states outside of the Corn Belt.
This is an industry that allows us the process of diversifying the opportunities in rural America to support production agriculture, to expand this bio-based economy so that we bring manufacturing back to rural areas, so that we have more stable farm income, and we give people opportunities to live, work, and raise their families in rural areas.
Vilsack asked the crowd to look at the value of renewable fuels outside of rural America. Hours after his Iowa speech, the secretary attended Green Fleet Week in San Diego and touted the U.S. military's uses of homegrown fuel sources. The Navy launched its first carrier strike group this week, powered by a mix of 90% ship diesel and 10% beef fat. The Navy has set a goal of filling half of their fuel needs with domestic biofuel production in the next 4 years.
It gives us a strategic advantage. It expands our options to fuel the fleet. Improving energy efficiency gives us a force protection advantage.
While the majority of corn and soybeans grown in the U.S. come from genetically modified seeds, the relatively recent invention has not been universally adopted across the globe. More than 60 countries, including Australia, Japan, and the European Union, have imposed restrictions or outright bans on GMOs. One concern among these nations is the liberal use of glyphosate, more commonly known under the brand name Roundup. Crops engineered to survive a dousing by the herbicide provide returns for producers, but resistance has sprouted over the past 2 decades in the form of superweeds. Producer Colleen Bradford-Krantz discovered that while Mother Nature is resilient, America's farmers are as well. Paul Yeager explains.
In the 1950s, scientists began noting the ability of certain weeds to survive herbicide doses that typically killed similar plants. By 1975, the number of weed types identified as being resistant to particular herbicides had begun increasing worldwide by an average of 11 cases per year. The United States faces the greatest battle with resistant weeds, followed by Europe and Australia.
Unless we start doing things differently, there's going to be the day rather quickly on larger and larger percentage of acres where we don't have herbicide options, and that's going to be a very scary situation.
The problem, which once seemed like a distant threat to many, is now forcing farmers in some regions to hire crews to hoe, cut, or pull the weeds, a practice largely abandoned 20 years ago.
You'll go through a field and cut them out, and then in 2 weeks you'll see some more that's popped up, and we go back and get those again. Because each one that goes to seed is several thousand seeds that will be resistant that you'll deal with the next year.
Experts agree the problem of resistant weeds ballooned with the expanded use of glyphosate herbicide, introduced by Monsanto in 1974 under the brand name Roundup. The company's genetically engineered Roundup-ready crops, the first of which were released in 1996, tolerated glyphosate treatment. Farmers rapidly and widely embraced both.
It changed our lifestyle as far as farming. Weed control was so easy. It wasn't a nightmare anymore, and we had less hand chopping and things like that, and it was just a very good product.
According to the U.S. Department of Agriculture, herbicide-tolerant crops now account for 94% of U.S. soybean acres and 89% of cotton and corn acres.
As we use products more and more over time, the potential to develop resistance is there, and so we're starting to see some challenges with some particular weeds in the field.
The first few years of a chemical's use may leave behind only a few resistant weeds, those with the right genetic code. Those weeds drop their seeds and become more prominent in subsequent years if the same weed killer is used repeatedly. In Arkansas and other southern states, the most problematic weed is Palmer amaranth, more commonly known as pigweed or careless weed. At first, just a few scattered stray weeds known as escapes remained in the field after herbicide was used.
Around 2009, I had sent some samples off of escapes in the fields, and they came back like 10 to 15% resistant to glyphosate or Roundup. Then the next year, I sampled them in the fall and sampled 3 fields. They came back 55, 85, and 100% resistant. That's how much it jumped in 1 year's time. Hello, Billy.
Texas farmer Greg Good noticed an increase in resistant careless weed in his cotton fields last fall.
In this particular field, you know, I had 1 or 2 last year, and then This year, it has really exploded.
Good spent many days over the past 2 summers weeding his fields by hand.
I would spend anywhere from 30 minutes to about 2 hours pulling weeds.
Palmer amaranth is particularly tough. Even after being cut and lying in a field, it can still develop roots and go to seed. Several northeastern Arkansas producers, including Piggott farmer Mike Morgan, estimate that hiring extra help to weed their cotton and soybean fields adds up to $30 an acre, on top of the cost of alternative herbicides. But farmers like Morgan say that ignoring the weeds could mean losing a third or more in yield.
It's a yearly fight for us now. We just know when we start a crop, we're going to fight resistant pigweed.
According to the International Survey of Herbicide-Resistant Weeds, almost 250 different plant species worldwide are resistant to one or more herbicides. Kansas, California, and Illinois top the list in the United States. In the Midwest, farmers already are facing off against tall water hemp. Southern farmers hope their peers to the north heed their warnings.
2010, I just see a spotted resistant pigweed just here and there in the fields, just not enough to really even worry with. If I'd had any idea, I'd have went right there and pulled them up, hauled them off, and thrown them in the hole and burned them like we do now a lot.
Most experts agree farmers must begin using a wider range of weed control options, including alternating chemicals, rotating crops, and increasing tillage when appropriate. Producers also are adding cover crops or looking at equipment that crushes weed seed. Both USDA and the University of Illinois at Urbana-Champaign are testing the Australian-built Harrington seed Destructor. The implement is designed to collect and crush weed seeds as they come out of a combine. And chemical companies are attacking the problem as well.
What we've come to realize is that we need multiple mechanisms of action in that overall weed management system.
Monsanto is seeking government approval for a new dual-ingredient herbicide called Roundup Extend, which will combine glyphosate and dicamba. And after previously giving the green light, the EPA is reconsidering its earlier approval of Dow AgroSciences Enlist Duo, a combination of glyphosate and 2,4-D. However, these new combinations may only buy time. And new herbicides, the last one having been created 3 decades ago, are unlikely to be introduced anytime soon.
When we think about the number of companies and the number of new products that were explored several decades ago, there was a lot of that going on. So a lot of that research and development has slowed down in the last few years.
In Clay County, Arkansas, extension leaders and farmers set up a zero-tolerance program to eliminate problem weeds from fields and nearby ditches.
We had just a handful that started out with what I call the zero-tolerance program, and then as others saw the benefit, they also got on board with the program and did the zero-tolerance program, some of them by choice. Some of them realized that their landlords was watching the other farmers doing a better job of cleaning up the field and looked better. Landlords liked that good, clean look. They kind of put a little pressure on them. You could call it peer pressure.
Traditionally, rice producers in the area have burned stubble after harvest, but some farmers have started to use fire in many of their fields. Experts say seeing a few remaining weeds may indicate more than a faulty sprayer or drifting chemicals. And for Cagle, ignoring the problem didn't make it go away.
When you figure out that you've got them, it's a mess. But if you start before you get them, it would be a lot easier. And I did that. I heard these stories coming from south of us, and I thought, that'll never happen to me, I don't do that. Well, it did.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
Export numbers, favorable weather forecasts in the southern hemisphere, and a 4-day trading week only serve to move the grain market sideways. For the week, March wheat gained 2 cents, while the nearby corn contract advanced 7 cents. Despite hot temperatures stressing South American crops, the overall export pace remains neutral to bearish for oilseeds. The March soybean contract gave up 3 cents. March meal dipped even further, losing over $2 per ton. In the softs, March cotton gained $1.04 per hundredweight. The dairy parlor saw February Class 3 milk futures sink 36 cents. Over in livestock, the April cattle contract gained $4.58. March feeders rose $7.62. And the April lean hog contract bumped up $1.55. In the currency markets, the U.S. dollar index gained over 0.6%. February crude left the board on contract lows, while the rollover to March saw the price rebound 20% to settle at $32.19 per barrel. COMEX gold gained $5.60 per ounce, and the Goldman Sachs Commodity Index rose more than 10 points to settle at $289.85. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome back.
Thanks very much. Glad to be here.
We are glad to have you. Let's talk about this week. Let's start in the wheat pit. We saw relative sideways movement. How is our wheat being handled overseas? Are we getting any moved?
Well, the sales, of course, continue on to normal buyers, people that we have the decent relationships with, of course, but competitive-wise, no. I mean, we are just not competitive against Europe. It's not competitive against Russia, Ukraine, so we're going to be basically getting the tail end of the business that's going on there. So sales, I think, improved about 30% this week, but of course that was coming from kind of disastrous levels the prior week. So small victory, but small keyword there. So.
As we look at the slightly smaller 3 million some acres of winter wheat plantings here in 2016, is there any hope of a significant market rally, or are we looking at 10 to 20 cents, make some sales?
Oh, absolutely. I think even at this point, if we could see 15, 20 cents above where we are, push back up against that $5 area, that's probably going to be a very, very stiff level of resistance. And it's, the sad reality of all of our commodities at this point is we have definitely moved to supply-side markets, which means we have to have a weather issue. Without a weather issue, demand is not going to be there to carry it. So until somebody has a little disruption in their production, prices are going to kind of drag along these price levels.
All right, well, dragging along, we saw corn pop this week, 7 cents.
7 cents is huge.
Great move in this moribund market we've had for the past almost year. 7 cents. Can we continue this run next week?
I'd like to think there's a little bit more room, but again, not leaps and bounds. I think I noticed before I wrapped up today, I think that was the highest close on corn since the 20th of December, somewhere in that neck of the woods. Yeah. And again, the sad part there is that certainly was not a monumental price at that time either. We'd like to think that between now and the 1st of February, we could maybe tack another 7 to 10 cents on the top of that. But here again, at that point, you're up against very stiff resistance. Not really any changes in demand. I think this is more of a function of technically oversold. You have some funds, I think, kind of recognize that, this boat is just way, way too loaded to one side. Maybe it's time to take a little money off the table, and that's stimulating that move more so than anything changing under the underlying fundamentals.
So how aggressively do producers need to be marketing that old crop corn on this bounce?
From our bias, we think it very aggressive.
Okay.
And not that as we move along, we can't have issues develop, but boy, if it is going to be a weather situation that drives prices, this period between now and April, May, there's really not that many factors that can make that happen. On the other side of the coin, you've got the strong dollar that continues to be the arch nemesis of almost all commodities here at this point. So realistically, yes, I think you market it on that push up. Let's say ideally close to $3.80 on nearby corn, maybe close to $4 on the new crop corn. Recognizing though that just because you sold today doesn't mean your marketing job is done. There are many tools you can use after that sale to position yourself for things that happen down the road. And, certainly it's, I think too often we fall into that trap that, well, I sold my bushels, I'm done. Absolutely not. Marketing is a 365-day-a-year job. So.
You bet. And so would you be looking on old crop and new crop both at, let's say, a call strategy to re-own some of those bushels?
Oh, certainly. And again, if we can make those sales against there, sure. I think if we get a breakdown, we all often talk about the February break. Mm-hmm. And I think I wrote in my newsletter a day or two ago that, we talked about the cruelest month, which... normally is not considered February, but in commodity markets, it's often February. So if we do get that kind of a break back down in the month of February, certainly we'll look at calls. And, for nothing else, if You know, when we look out the summer, and our bias at this point is we have very little risk premium in prices if there is a weather issue develop come summer. You know, if you can own some calls now, it gives you that peace of mind to make those sales once we do see those pops in the summer months. So it just makes you a little more comfortable psychologically as far as making the decisions you need to make.
You bet. All right, now let's move into the soybean market. A little sideways to negative on the week. Do you see beans? Is there some opportunity to market these old crop beans here in the next 2 weeks?
You know, and again, the same situation here. It's going to be technical if it happens. South America really is not you know, there have been some issues, don't take me wrong, but certainly not widespread enough to really accelerate prices. Before falling back today, we were kind of, in fact, the close we posted yesterday looked like we were maybe ready to revisit that $9 area. That said, we're talking about 20, maybe 40 cents in the bean market. That's really just that's skipping.
You bet. Now, we've got a question here from one of our viewers. This is from Roger. He follows us on Twitter. You can find us at Market to Market. And he's wondered what's going to happen to basis moving forward. And let's talk in the soybean market.
Well, you know, of course, basis on a general sense, of course, will, you know, as time progresses, we're going to need to bring X amount, you know, be it for crush, be it for exports. I mean, there is demand. It's not overwhelming us by any stretch of the imagination. So, you know, unless you're sitting in a situation where your logistics or your transportation is having some kind of a nightmare issue, basis will continue to improve, probably right into the summer months. You know, no reason to think that that isn't going to be a normal track. And of course, I mean, there's been a lot of articles published recently about the travails now in the rail industry, almost giving away rail cars because the leases that are out on them. So that could really put some pretty strong basis levels in areas that are rail dependent.
All right, maybe a spot of sunshine as we look out to the future. Now, speaking of sunshine, as we look over at the cattle market, last week was dismal. This week we're following that cattle market pattern of down and up. We're up this week.
You know, and it really not unusual for bottoming type action in the cattle market, and certainly got tugged around with all of the economic woes, you know, be it China or the U.S. and the volatility we saw in the stock market. But I think by the end of the week we kind of shook that off. And, you know, seasonally, it looks like we probably have some better prices, at least to look at between here and summertime.
So this would not be a place to start putting some hedges on?
You know, and again, I would hesitate to say no. If you're looking at profitable levels, in fact, we had several people this week that came in and said, you know, I'm looking into the summer months. I can hedge in profitability here, and you know, if that's the case, take advantage of it. I mean, it's still going to be plenty of volatility. I don't think the upside is unlimited by any stretch of the imagination. But so, I mean, if you're looking at levels you can make money at, take advantage of it. You know, maybe use option strategies to give yourself a little more flexibility, but absolutely lock in one in the hand's worth two in the bush, certainly.
Okay. Well, now let's look at this feeder cattle market. There's been a lot of talk about this herd growing, where we should expect to see that continue in 2016. Put $7 on it this week. What does the future look like for feeder cattle?
You know, a very similar situation. You know, I think we have a little positive track on them right now. We could probably see another 30 days, maybe 45 days of offensive action. You know, I'm not going to say a runaway bull market by any stretch. But on the same token, you know, there's just a limit. I just don't think there is enough economic activity out there to really get people excited about loading up freezers or, you know, spending a lot of extra money on higher price cuts of meat this year. So it's and certainly, you know, if numbers are expanding, you know, there's going to be more people fighting over the same feedlots to get those cattle out there.
Especially if we could see some profitability return on the cattle feeding side.
Absolutely, on the fat side.
All right. Now let's look at the hog market. This has been a fascinating market. We took that huge sell-off in the early fall, and now we've been trying to claw our way back. We're pushing that $70 mark in the nearby. How strong, or what's the next big level of resistance in pork?
You know, there as well. It's been a great rally, been very consistent. I mean, not fast and furious. I mean, not volatile. We really climbed up to, you know, sadly, what were lows last year in that 64 to 70 range. You know, here again, too, I finally moved back to where we put some people back in the black. I think it's going to be difficult to move it much further than they have already, at least for the time being. So, yeah, you can look at the summer months. We've got some nice premium built in there. So, absolutely, with our hog producers, we've been recommending time to lock it in and just basically take advantage of this rally we have experienced.
And how far out would you be locking in some of those aggressive summer premiums today in the hog market?
Oh, absolutely. Yeah, absolutely. I think it's, you know, and again, it's back to levels where you can make some money. We haven't had any kind of major health issues over the winter months here. The numbers as a whole, we should be looking at 1 to 3% higher numbers. So, you know, like I say, unless this economy is going to surprise us in some fashion and really take off, where people feeling great about spending money on extra food this year, probably got a pretty limited upside.
Now, one of the challenges we've seen for hog producers in particular is we watched the soybean meal market. It seemed like just 2 months ago, 300 was a line in the sand we'd never get through. Now we're trading at 268. How far out do you begin to acquire your feed needs if you're a pork producer today?
You know, and again, I mean, the meal market, of course, has been the drag on the whole soy market here for the last several months. Ironically, here there were a lot of stories out earlier this week about the record meal exports are going to go to, not just from us, of course, but to China this year as they're rebuilding their herds. And of course, meal is very cost competitive there as well. So, you know, I think absolutely. I think if you're locking in the fats into the summer months, you want to have your meal covered all the way. I mean, you don't need to have any unexpected surprises there that's going to change that overall picture. So,
outside of unexpected surprises, is this meal market going to continue to be a drag in the soy complex?
You know, it's yes and no. I mean, I guess when I look at commodities as a whole right now, and you know, I tend to try to take a little bit more of a macro picture right now. I mean, the micro things, we're not going to change much anytime soon. You know, we're not going to have a big disruption in production. We're not going to see the demand shift dramatically one way or another. So when you look at the macro side of it, I mean, look where commodities are. And I think we really reached the point where, be it crude oil or the grains or almost any commodity you name out there, we've moved beyond fundamentals. I mean, this is just a money situation at this point in time. I think very realistically, we could be sitting a year from now looking back and saying, gee, what on earth were we doing at those kind of price levels? So it's, I think in the bigger picture, you don't have a lot of downside risk. Not that there's necessarily a lot of immediate upside risk, but you know, if you compare the two,
we've got the downside out of the equation.
Right.
Thank you so much for joining us, Dan.
Absolutely.
That wraps up the broadcast portion of Market to Market, but Dan and I will continue our discussion and answer some of your questions in the Market Plus segment available on our website. While you're there, you can check out our social media outlets and interact with us. And join us again next week when we'll examine agriculture's impact on policy in the nation's capital. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.